Right, good afternoon, everybody. Hello. Sorry about the delay there. I was talking to a screen with the microphone off. Right, I'll take me off. So welcome to Financial Management for My Business. So this is a bookkeeping and financial behaviours for a small business workshop. Any of you who are here now, sorry, welcome. Any who are here now, welcome. Anybody watching this on catch up, which I'm sure there are some, hello, and I hope your evening is going well. So this is about finance and bookkeeping for small businesses. It's about, it's about 3 hours long. I'll take a couple of breaks along the way for a refreshment of my coffee. We will be discussing quite a few of the aspects of small business life, really. So financial terminology, compliances, by that we mean, when do you have to register for the taxman? What do you have to tell the taxman? What records do you have to keep for the taxman? I say the taxman because HMRC, and it probably should be tax person, I know, but historically it's always been the taxman. HMRC, records you need to keep, when you need to register if you're a sole trader, that side of life. We'll look at cash flow, we'll look at a P&L, profit and loss. Particularly interesting to most people starting businesses or in the early stages of businesses is what I can and can't claim as an allowable cost, because your allowable costs, as I'm sure you know, are what reduce your tax bill. Because the process is very simple. You earn money, but sole trader this is, it's pretty much the same for limited company, but a fraction less straight line. You earn money, you deduct from that money what you have spent earning it, and what's left is yours, and you get taxed on that. So money in minus money out equals what you get taxed on. So from that, it is clear that if you can find more things that qualify as money out, you'll get a lower tax bill. So it's about claiming as much as you possibly can truthfully and reasonably, and knowing what you can and can't claim. First off as well, I should state, I should also state at the very beginning, welcome, good afternoon. My name is Mick Dobson. I'm a business advisor at Wenta in Watford, where I am currently sitting. This is, as I say, about 3 hours long, and I'll take a couple of breaks in the middle. And I am not an accountant and I am not a lawyer. None of us are. So this is delivered from a generalist point of view. This is not financial advice. This is process advice. This is how it works and information. Particularly things like tax rates, national insurance rates, the things you can and can't claim as an allowable cost. They are all on HMRC website. If you need specialist advice, speak to somebody who can give you it. By that I mean a qualified accountant, HMRC themselves, something like that. This I stress, and I'll probably mention this as we go along. I am not an accountant. This is not financial advice, because financial advice is a very specific thing, and I'm not a financial advisor. So we're going to look at the differences between sole traders, partnerships, limited companies, partnerships in passing pretty much. We'll look briefly at partnerships because effectively they are. A partnership is a conglomeration of sole traders. So the process that applies to sole trader applies to partnership pretty much. So we'll look at those. What's the difference? Why would you form one and not the other? What are the differences in record keeping? That sort of thing. We'll look at practical bookkeeping. And by practical, we mean, there's people coming along. Hello, there's a couple of extra people turned up. Hiya, welcome everybody. By practical bookkeeping, we mean what records do you need to keep? A, for your own information, because you've got a business to run and grow, and at the very simplest level, you need to know what's gone out, what's come in, and where it went and where it came from, that sort of stuff. Very straightforward. A spreadsheet will do it in most small business cases. So we'll look at that, what you need to do, A, for HMRC, B, for you, for your information. X is profit and loss, cash flow, expenses. That's allowable expenses. That is what the taxman will let you take off your turnover before you're assessed for cost, for tax. So we'll look at that. P&L, cash flow. Those are the two spreadsheets that are probably going to be useful to you. Certainly a cash flow. Please do a cash flow if you don't do anything else. And you'll hear me say that more than once as we go along as well. Invoicing, we'll look at what's an invoice, what does it have to look like, what records do you need to keep in that regard, and we'll look at VAT and tax. And yes, I know VAT is a tax. That's what the T stands for, of course. But it's not a normal tax. It's a special tax on outputs. So we'll look at how that works and at what point you need to register. Should you register? How does it work? And we'll look at the tax rates. So what tax do you pay if you're A, a sole trader, B, a limited company? And I use the terms sole trader and self-employed. I use the terms interchangeably because you are a sole trader, you are self-employed. HMRC, when you register for being a sole trader with HMRC, you don't register for being a sole trader, you register for self-assessment. So you're telling HMRC that you're doing your own thing and you're going to do your own tax return. That's what you're telling them. And you're doing that as a sole trader, as a person trading on their own account, as it used to be called. As a proprietor of your own small business, you are a self-employed person. And those terms are generally used to mean someone who does their own tax, where they are the business, as distinct from a limited company, which is a separate thing that you form. And here comes the first of many adverts. We've got a webinar on how to register as a limited company. I think that's coming online very shortly. I know it's written, it's on its way. So how you register, how you incorporate. Incorporating a limited company is dead easy. It really is. Running one and keeping the records are less dead easy, but they're not difficult. So we've got a webinar on that. We've got webinars on marketing. We've got webinars on all sorts of things. There's heading for 40 webinars on our website. And you know there are because you've booked on this one. So without further ado, let's leap headlong into the fun. Legal status and basic bookkeeping. Right, sole trader. Sole trader, we'll look at sole traders first because they are not exactly the lowest form of life. They are certainly the most common form of life. One of the webinars, which I delivered just before Easter, the figures are enormous. The number of single person businesses in the UK is just massive compared with all other forms of business. And if you add together the single person businesses and those businesses with less than 10 employees, which is predominantly people with 2 and 3 employees, that's based on what we see here. The numbers of people with 1 or a very, very small number of employees is about, from memory, something like 80% of all trading entities in the UK. It's massive. So sole trader, it's the most common form of business registration by a long, long way. To register as a sole trader is extremely easy. Refer you to our webinar if you like. Also refer you to getting in touch with one of us. Book an appointment for one of us to go through it with you by Zoom. It's really straightforward. You do need, if you're going to do it, you do need a working email address and a working phone. And I know that sounds blindingly obvious, and I know pretty well everybody does have, but if you don't, you can't register because they send you confirmation back by email to make sure it really is you. There's lots of cross-checking, and you need a phone, you need an email, you need a, what else do you need? National insurance number, phone number, address, that sort of stuff. So sole trader, it is, as it says on the second one up there, simple to set up and to administrate. It is very simple to set up. Setting up as a sole trader, registration takes, even allowing for them send, because you register through the government gateway, you see. The government gateway is their thing, HMRC's thing, for all things tax. So if you're a sole trader, you register through the government gateway. If you're a limited company, the limited company registers with the government gateway. Then you sign into the government gateway, into your account effectively, and that's where your VAT stuff lives. If you're VAT registered, it's where your self-assessments live. If you're doing self-assessments, it's where all your gear lives on the HMRC side of life, if you like, in the HMRC cloud. So being a sole trader, why would you want to be a sole trader? Well, it's firstly, the main reason will be it's dead easy. There is an advantage to being a limited company. It's slim. Financially, it used to be considerable. I'm trying to remember when. Must be 8 years ago, a good long time ago anyway. The rules have changed on how you get taxed as a director taking dividends, which is directors can take the profits the company has made. They can issue the profits to the shareholders. That's what shares are for. And it used to be a really, really good deal. But now HMRC, they tax dividend. Dividend did not used to be taxed. It is now taxed at 7.5%, which takes away most of the financial advantage of having a limited company over being a sole trader. There is still a small financial advantage, but it's compared to what it used to be, it is quite small. So why would you be a sole trader? Well, it's easy, it's light, it's fast, it's all these things. The record keeping is light. Yeah, you can go from being a sole trader to being a limited company instantly. Well, as fast as you can form a limited company, which is usually within 24 hours. I say usually, it's actually usually same day if you get early in the morning. HMRC Companies House say within 48 hours. I think once you do the registration process online, and they commit to within 48 hours sending you all the incorporation confirmation by email. Normally, if you do it early in the day, you get it same day. I don't know anybody who's had it in taken more than 24 hours. So it's quick, but sole trader is instant. Registration is very, very fast. Actually, you get sent a unique taxpayer reference in the post, I think, still sometime later. But the actual registration process is very quick. So why would you be a sole trader? It's fast, it's easy. You're completely responsible for your own affairs, and you must keep good records, and you must pay income tax on your profits. Those are, well, that's the law. Partnerships are made of sole traders. So if you're going to be in partnership, you need to be a sole trader to start with. So just to explain, I'll just check. I think we've got the timelines next. Bear with me. Yeah, we have. Bear with me. It's a couple of weeks since I've delivered this one. So yeah, if you're a partnership, or there's say 3 of you planning on forming a partnership, you 3 will be sole traders. You will be self-employed people. You will be registered for self-assessment yourselves. So the 3 of you register for self-assessment, same way as everybody else does. And then one of you is designated as the lead partner. This isn't a legal position. It doesn't carry any extra weight or risk. It's just one of you is nominated as the main contact, if you like. And then that one registers the partnership. So you form a partnership, register a partnership, and then tell Companies, is it Companies House? Yes. No, sorry, it's HMRC. Who is in that partnership? So the partnership registers, and the partners within it confirm that they're in it. And the process is like doing a self-assessment registration twice over. So to register, you must do it by the 5th of October in the next tax year. What's that mean? Well, these are your timeline milestones, I guess. Milestones. If you start trading now is a really good time to start trading, because if you start trading now, your first tax year will end there, 5th of April. So let's say you start trading. Let's make it a little more varied, because at the moment we're at the very beginning of April. So you're getting pretty much a full year if you start trading now. If you start trading mid-year, so let's say you started trading, and this is perfectly feasible. You don't have to register when you start trading. In fact, you can't. You register after you've started trading. I don't know why, but you cannot register in advance. They won't let you. The registration process says, when did you start trading? And if you try to put a date in that's not in the past, it won't let you. It bombs you out. So you have to be trading already when you register. So, and that's quite good. I mean, a lot of people think you have to be registered, and they're very nervous because they've started selling things. No, you start trading. Let's say you start trading in August. So you start trading in August last year, August 2022. You start trading. 5th of April, your tax year ends. Whenever you start trading. So we've gone August 1st of August, let's say. 5th of April, your first tax year ends. That's because it's the government tax year, it's the tax year. That's when it ends, midnight on the 5th. Then your second year ends midnight on the 5th. That's how it works. So your first year, as you can see, is short because you started trading in August. That's fine. Everybody does it like that. If you start trading in January here, you've got a very short first year, that's all. So 5th of April, your first year ends. Now, you started trading on the 1st of August. You haven't registered yet. That's the deadline, 5th of October. And I'm just going to go back on where it says register by 5th of October in the next tax year. It's that. So the tax year ends on the 5th of April. You started trading there. So the next tax year is the one we're in here, between 5th of April and 5th of April. And that is the 5th of October in the next tax year after you start trading. So you start trading, April turns up, and the October after that is when you must register by. So in reality, you've got months and months. Why you wouldn't register before then, I don't know. That's entirely up to you, but that's the deadline. There's no earthly advantage in leaving it late. You need to keep records from when you start trading. So you start trading 1st of August, you keep records from the 1st of August. Those are the rules of the game. So now I haven't been paying attention, and other people have turned up as well. So hello, everybody else who's turned up. I'm so sorry. I wasn't watching that. I get carried away. So welcome, everybody. Welcome, everybody who's here. We've got quite a few here. That's cool. So sorry, but that was a Ferrari outside. I think there's somebody parked in the wrong place. Sorry. Yes, so 5th of April, your first year ends. You must register by the 5th of October. You may as well register as soon as you've, when you've got to the start trading thing, really. Just after you've started trading. But you must keep records from when you start trading, and you can go back 6 months with spend. So the costs of up to 6 months before you start trading, because it's going to cost you money. Before you start trading, you're going to be spending money on software, maybe a laptop, stock, rent, deposits, I don't know, all sorts of things. But the money you spend before you start trading is an allowable cost in your first year, because you've got to spend some money before you start trading so you can start trading. If you're opening a shop, you spend quite a lot before you can start trading because you've got to open the shop. So start of trading is Start of trading is 1st of August, 5th of April, your tax year ends. You must register. And then on the 31st of January, you've got your tax return. So start trading 1st of August, tax year ends 5th of April. This period here is your first tax return. That's what you're doing your first tax return for. And that you do by the 31st of Jan. So you've got to do your first tax return by the 31st of January, right? So 5th of October registration deadline, 31st January self-assessment deadline. Then comes your second year ending. As part of your first tax return, you make a payment on account. So you will pay tax on the money that came in during the period. So during this period here, if you sold £10,000 of stuff and it cost you £2,000 to do it, you're going to get taxed on £8,000. That's how it works. They also, because remember, you're paying your tax here. You've been trading for this period as well. When you pay your tax here, you're paying tax for this. You've been trading another 10 months. So they, HMRC, take an assessment of this. They take 50% of your tax bill for that year. So they'll charge you your tax bill for that period, and then they charge you 50% on top of that as a payment on account for this 10 months that you've been trading. And then they charge you the second payment on account in the July following, because you've been, you're working 10 months without paying any tax. And that way, they're keeping tabs. You're not running up a massive tax bill, which you'll struggle to pay. Please put money aside to pay tax, by the way. It's the best way. Yeah, that's the deadline and sort of mark points, timescales for sole traders and partnerships. Now, in addition to all of that, there are limited companies, which is a separate animal altogether. A limited company is not you. A limited company is a legal entity in its own right. The main difference between a limited company and you being a sole trader operating on your own account is that that a limited company is a separate thing. It is a thing. When you incorporate, when you form a limited company, you're bringing into existence a legal entity, and it requires accounts to be filed on public record. It comes all this, and it costs, I'm trying to remember, £12. It costs £12 to form. You go online to Companies House. We have a webinar that explains how you do this, which is going to be up very shortly. You go online to Companies House. You spend a happy 15 minutes or so putting information in about the company, its name, your address, your phone number, your email address, the number of shares you have, that sort of thing. It's a very straightforward process, costs 12 quid. And when it's finished, you own a limited company. You are the director of and shareholder of, unless you involve other people as well, a limited company. So given that the Companies Act require accounts in a specified form, et cetera, there is a little bit more bookkeeping to it, a little bit more detail to it than there is to being a sole trader. You have to keep the same records in the same way, but come the year end, the entry of the information into HMRC's website is more complex than doing a self-assessment for a sole trader. Not massively so, but it is more complex. There is much more to it. It takes longer. So be aware, if you want to do your own, books for a small limited company, which you can do, you don't have to have anybody else involved until you get to, and I'm still not sure of this. I say this every time I deliver this webinar. I'm pretty sure it's 10.2 million turnover. They may have changed it because HMRC change things in the budget now and again. But it's 10.2 or thereabouts million turnover. Then you have to have somebody else involved. You have to be audited. But for most small businesses, the choice is, shall I do it myself? Shall I use a bookkeeper? Shall I use an accountant? And that's entirely up to you. But those are the choices you can make. There is no requirement that you use anybody else at all. There is no requirement that you use specific software, because as a micro entity, so if you form a limited company and it's just you or you and a couple of others, your turnover is probably going to be under 632,000 and your number of employees is probably going to be under 10. There's a couple of other criteria, but HMRC have criteria for you being a micro entity, and a micro entity doesn't have to send notes to the accounts, doesn't have to send, you don't have to publish an awful lot of the things that company law requires. You're exempt from an awful lot of stuff if you're a micro. And a micro entity is, as I say, 632,000 turnover is the mark point. Now, that's huge. I don't know very many people. I mean, most of the people we see are turning over. You could divide that by 10 and you're still well over what a lot of people turn over. A lot of sole traders are very small, and that's the nature of the business. So to be a limited company, there's nothing to stop you doing it yourself. You can do your own books, you can keep your own records. Bear in mind, so that's what this small company audit exemption is. That's what that's about. Bear in mind, as a limited company and as a self-employed person, sole trader, call it what you will, you must keep your records for 6 years. That's the thing. 6 years is the, right, it's 6 years including the current one. Oh, sorry, plus the current one. So 6 full years. So now we have just turned the corner into, if your company year goes April to April, we've just turned the corner into a new year, a new tax year, certainly on the HMRC years we have. So you can probably throw away the oldest year you've got records for, if you want to. So in this year, you must keep year ending the 5th of April, 2023, 22, 21, 20, 19, and 18. So year ending those you have to have if you've been trading that long. Obviously, if you've only been trading 3 years, that's all you've got. But you must keep records, 6 full years of records. So by the time a tax year gets towards the end, you'll have nearly 7 years of records. And then when the year clicks over, you can throw away the old one. Given that most of your records are going to be online, in the cloud somewhere, in some form of software, you may as well keep them just for good order, really, just for you being able to look back. Excuse me, but that's up to you. The rules are you've got to keep 6 full years. So Forming a limited company. Why would you want to form a company? Why would you do it? There's 5 main reasons that I can think of. 5 reasons. There's the name, perception, money, risk, and name, perception, money. Right. So start with name, and your clients. Sorry. So starting with the name, people form a limited company to save the name. Because if you've got a limited company called Cats R Us, nobody else can have that limited company name in the UK. Can't be done. So if you're operating as a sole trader, as a vet's maintenance company called Cats R Us, you might want to form the limited company and leave it dormant. So nobody can have that name. So if you want to change from being a sole trader to being a limited company, you can without changing your name. Because how annoying would it be if you've been operating for some time, let's say as Jim the Builder. So Jim the Builder as a sole trader, and somebody says, we'll give you some massive contracts, but we'd like you to be a limited company. And you try and form the company, you find that somebody else has already got Jim the Builder. You can't have it. That's, there's no way around this. You can't have it. So quite a lot of people are starting now to invest the 12 quid, which is what it costs you to form a limited company. Invest the 12 quid, form a company, and whilst you're forming it, one of the questions you're asked in the process is, when are you planning on trading through this? And you have 3 options. So when are you planning on trading through this? A, now, fine. B, at some date in the future, in which case it says, when is that? When do you plan to start trading? Excuse me. C, I am not planning on trading through this. So that means you are planning on leaving it dormant. So that means Companies House and HMRC know that you won't be trading. Therefore, you probably won't be doing any tax returns or anything else. Once a year, you go online and confirm that you own the company. It's called a confirmation statement. You go online and confirm who owns the company, the addresses, and all the rest of it. All the details you put in when you formed it. And that costs, I think it still costs £13. So if you form a company that you never ever trade through, just so nobody else can have that name, it'll cost you 13 quid a year. And people do that. So one reason to form a limited company is to save the name in case you ever want it. And also to stop other people having it and possibly confusing your customers. So the name is one. Perception is another. If the industry you're in, the default position is a limited company, then you should go that route because that's what people expect. Just as most accountants, doctors, lawyers, dentists are partners in partnership, because historically that has been the way. So for some industries, limited company is a standard thing. And if what you do fits best in a limited company, then that's a reason to do it. If it's just the right thing to do, or it suits you to do it. So that's one reason is to save the name. One reason is because the perception of the perception of what you do fits better. Third one is your clients. Your clients may force you to be a limited company. If you're trading, if you're offering services to local authorities on their behalf, they probably will want you to be a limited company. They don't mind if you're working on their buildings or cutting their lawns, but if you're delivering services on their behalf, delivering consultancy services, for example, into the health sector, you are probably going to have to be a limited company because they won't place the business unless you are. And if that's the case, you've got to be a limited company. You'll be forced into it by your clients. The other two are money and risk. So those 3, your clients, the perception, and saving the name. And then there's money and risk. Money, yeah, people form limited companies just because you will get a bit more money. It won't be massive, but there is a little bit more money stays your way than there is as a self-employed person. As I say, it's not massive, but there is a financial advantage. There comes a point where it's financially better off. And the last one is risk. And risk is a very real thing because as a sole trader, it's you. There isn't anybody else. There's you. So if it all goes badly wrong, so let's say you're a caterer and it all goes horribly wrong and somebody gets really, really ill, possibly even dies, it's you. You're in trouble. Unless you can prove that your cold chain is perfect and you've stored everything as it should be stored and you've got total records to prove that, Therefore, the fault must lie with wherever you bought the food from. So unless you can do that, you're in trouble. And hopefully your insurance will cover you. But when the buck stops with a sole trader, it stops with you. Now, the difference with the limited company is that the limited company trades. You don't trade. You're a director of a company. You're employed by it, probably. You own it if you own all the shares, but you are not it. It takes orders from customers. It sells them food, meat, catering equipment, whatever. It gets sued when something goes wrong. So this risk thing is it's not worth doing it. It's not worth forming a limited company just for the risk if you're in a fairly risk-free business. Unless there is a serious risk. For example, if you're in the building trade, heavy goods, anything with dangerous processes involved, be worth thinking about this hedge against risk that a limited company offers you. So it offers you this protection because it is what gets sued, not you. It is at fault. Unless you are guilty of criminal negligence, criminal behavior, a health and safety breach. In some instances, such as those, the law can say the buck does not stop with the limited company because you as director and owner should have known better, or you knew what you were doing and you knew this was criminal behavior, for example. In those circumstances, the law can say, okay, all bets are off, then you personally are liable. And that is incredibly rare. So generally speaking, a limited company offers a risk hedge, if you like. But if you're properly insured and properly sorted out and behaving honorably and doing nothing wrong, it's unlikely to ever be an issue anyway. But risk is a reason, risk avoidance, if you like, or risk insurance almost, is a reason why some people form a limited company rather than being a sole trader. So those are reasons. Another reason, this dividend payment's down the bottom here. Oh, by the way, yeah, filing deadline is 9 months after your year end. I'll just touch on those. So if you form a company in August the 1st, the next August the 1st, actually July the 31st, your first year ends. And then you've got 9 months to do your tax affairs. So a company has its own year. It doesn't go on HMRC's year. A limited company has its own year starting when it was incorporated. Unless you incorporate it and leave it dormant, as I said earlier, in which case they know you're not trading. So you can leave it dormant. And then if you contact HMRC and say, let's say in the following February, so you register in August, nothing happens. And then in the following February, you think, I've got to start trading through the company. For whatever reason, you contact HMRC, you contact Companies House, you say, email, I am now trading from this company with effect from the 1st of February, and you start your books from that date. And then the following 31st of January, your year ends, and then you've got 9 months to do your books and get your tax return in. So a company has its own tax year, and you personally will do a self-assessment as a company director based on the government's tax year. There are penalties for late filing. There's penalties for late filing to do with everything. Sole trader, partnership, limited company. If you miss a date, they fine you. Usually £100 for the first date you miss, but they fine you. Small company audit exemption we've covered. And dividend payments are how you pay yourself if you're a company director. So it's generally the first 2,000 of dividend. I'm just trying to remember. They didn't change it in the budget. The first 2,000 of dividend is tax-free. Thereafter, dividend is taxed at 7.5%. So it's a very good deal. It's you taking money out of the company at a very low tax rate. But the money you take out of the company is after the company has done its tax return. So there is a way of paying yourself through a limited company using dividends that is not the same as taking salary and is a slightly tax advantageous way of doing it. So your bookkeeping and your accounts, it is essential to keep accurate records and it's a legal requirement. So it's essential from your point of view. You need to know, because if you're keeping rubbish records and you think you're doing really well and it turns out you're not, that's a nasty shock you can do without. So keep accurate records. It's essential for your management, if nothing else, of your own business. It's used, obviously, to determine the success and financial health of a business, and it's the basis upon which you pay tax. Another pause for coffee there. You need to set out your bookkeeping records clearly. Clear, truthful, and transparent is what your records need to be. So bookkeeping is day-to-day records of your income and your expenditure, and the accounts are summaries of those things. Limited companies have statutory accounts. There is an exemption, as I say, for very small ones. And then there's an assortment of management tools, P&L, cash flow, forecasts of various types. Sales forecast usually is the prime among those, but there are also people do cost forecasts sometimes, depending. It's all about what you need. It's not, you don't need to go into a company thinking, right, what do companies like me have? Therefore, I should do it like that. I should do it like they do because they've been here longer than I have. Well, maybe, but as long as you comply with the rules and send HMRC what they want and keep the records you're supposed to, just do what works for you. Running a company is very simple. You know, it's a minor administrative process. You keep good records. That's what you do, and you have the ability to add things up at the year end, and also at various points as you go through the year. Because at the end of each month, you need to know what position you're in. I suggest. So it's not difficult. People think, oh, I've never been in business before. I don't know about being in business. Well, being in business is just a matter of buying things, selling things, and keeping track of the money. And it really is that simple in process. Now, if buying things and selling things and keeping track of the money is something the size of Virgin Enterprises with, you know, railways and balloons and space travel, he's stopped the space travel one, hasn't he? But that business, they buy things, they sell things, and they keep track of the costs. But the number and the amount and the size and the variety of all the things they do means that the process is massively complicated. But to summarize it, it is simple. They keep track of what comes in and what goes out. So that is what you must do. Keep track of what comes in and goes out. And there are very simple ways of doing it. There's very straightforward, like historical ways of doing it. There's incoming and outgoing cash, incoming and outgoing orders. There's things like that. Every penny received and paid by the business has to be recorded. So money owed, money owing, bank reconciliations, these are things that will be very helpful to you. For example, this is the old-fashioned way of doing it. We'll look at, where are we? There we are, cash book and the sales and purchase ledgers. Now, you probably won't do this. You will probably use a piece of software or possibly use a spreadsheet you've put together yourself. But the records must include your cash book, your sales and purchase ledgers. So that's a record of money in and out of the business and a record of the orders the business has placed and has had placed upon it. That's what those are. Your bank account, obviously, a diary showing where you've been and what you've done, obviously, and a VAT account if you're VAT registered, and PAYE if you have employees or are paying yourself in a salaried way. So this is an old-fashioned way of doing it. This is the cash book. There's a cash book, money in, cash book, money out. That's what a cash book looks like. I'm going to go back and do them slowly. Then there's the sales ledger and the purchase ledger. So the old way of doing it, a cash book, and this will be a piece of software, which we've got a list of in about 5 slides time, as you probably saw. It'll probably be a piece of software. But the old-fashioned way of doing it, where people would sit with a big book and a pen and write it all out, pre-computer. And pre-computer isn't actually very long ago. Pre-computer is like 60s, certainly early 70s. Computers were not common in business until the mid to late 80s. Certainly early 70s, they were very, very rare. So people would be writing stuff down. And they would be writing down things like the date, who was it, how much was it cash, check, or card, and has it cleared the bank? And that's the basics. So listed out across the page like this, it's easy enough, but that's all it is. When was it, who was it, how much did they pay, how did they pay, and has it cleared the bank? The has it cleared the bank question, generally speaking, is down to checks, because a check will be written by the customer and then it crawls through the postal process, and 4 days later it gets to your bank, and then it takes another day to clear. So there's a paper record of the money floating around until it clears the bank. So then the bank shows the money in your account. So there was a gap between being paid by check and the bank getting the money. That is not the case now, because well, it is the case, but slightly. So if somebody pays by direct transfer, it tends to be instant. Credit or debit card, it's same day, next day, it's very, very close. So the has it cleared the bank question has largely disappeared. But that's the cash book. That's cash in, cash moving into the business. And the other side of a cash book is cash going out of the business, which is the date, who was it, how much did you pay them, cash going out, notice. So date, who was it, how much did you pay them, how did you pay them, cash, check or card, and has it cleared the bank. The has it cleared the bank. So this side of things up to here, this is activity. So you could say, right, I bought £500 of the stuff from a supplier and I paid by card. I know I've got £500 going out to that supplier and I've got the goods. And the £500, let's say, because you paid by card, clears the bank the following day. It's important that you know, because if you do a bank reconciliation at the end of the day, £500 has gone out, won't be shown in the bank until tomorrow. That's why you need to know. You need to know what you've written. And with a single business, a small person business, sorry, a small business, a single person business, with a single person business, it's not really difficult to keep track, because you'll know if you've bought stuff that hasn't yet come out of your bank account because they've given you credit, perhaps. That's the main reason for it. You've bought stuff, you've got 30 days credit, so you've got the gear, and in 30 days, the money comes out of your bank because you're going to have to pay them. That sort of thing is really important. And it doesn't need much of a process, because you'll probably remember until you get bigger, and then you need a process. And that process is this. What have I bought? Who from? How did I pay them? And has it come out of the bank yet? And if it hasn't, I need to take account of it in my thinking, because I know that 500 quid less than I thought I'd got, 500 quid less than the bank shows, is what I've actually got. That's cash book. Then, if you want to, you can lay it all out beautifully. So cupcake trading in October. This is money in and money out. Money in, Abbey account, £1,000 from the owner's savings account, let's say. The owner's invested some money. So money in, 1,000. Colonel Mustard, 175, sales. Mrs. Plum, 225, sales. So the total goes in here, and what it is, this tells you what it is. It's sales, or it's money invested by the owner. So these are the sales, these are the sales for this period, and that's the total. Now, you're probably going to use a piece of software or a spreadsheet for this. Then there's the analysed cash book, the date, who was it, how much, and what was it. So Acme, £250 worth of stock, spent £90 with Viking, spelling error, £90 with Viking, that was admin stuff. £210 with BT, admin. So there are the totals, and this breakdown to the side tells you what they are. So you don't add this to this, because this is a total which should be the same as the sum of these. And that's an analysed cash book back in the day. You'd write it down. On the 6th of October, I spent £340 with the local advertising newspaper, which is marketing, so it goes in there. So I can see how much I've spent on each of these things, stock, rentals, premises, admin, during the month. So that's an old-fashioned cash book. As I say, they're pretty much gone by the board now, because people tend to use software or spreadsheets to do the job. Then there's a sales ledger, very similar. The date, this is money going out, sales and purchases from the company, not cash, sales. So the date, the invoice, who was it, how much was it for, have they paid you, and how did they pay you? And buying things, the date, the invoice number of your supplier, who was it, how much, was VAT included, if not, or not, sorry, net plus VAT equals gross. It depends on whether they are VAT registered or not, whether they charge you VAT, because if you're not VAT registered, you can't charge people VAT. That's the law. And the date this all happened, and when it was paid, when the payment was made, how was that payment made? And there's a few bookkeeping packages that might be useful to you. Xero, Free Agent, Cashflow Manager, Sage, QuickBooks. Please note these are examples. There are others, and new ones crop up all the time. There are some free ones. There's one called VT, which I think does a very basic spreadsheet type bookkeeping thing, which is free to use. But these things, from memory, they cost about £25 plus VAT a month. They are very comprehensive and very slick. That's for a limited company. I think sole traders are about 15 quid a month. They're very tidy. They'll do pretty well everything you want. They'll reconcile your bank if you let them talk to your bank. If you can give Free Agent, you can give them access to your bank, sign into your bank, set up a link, and they learn. So if you're buying paint from Zoe Jackson's Paint Supplies, the first time you have to put it in, you say it's paint, it's cost of sales, and the next time something comes from Zoe Jackson's Paint Supplies, the package will know that it's a cost of sales entry. It'll put it in the right place in your books. They're very clever. So those are some software bookkeeping packages anyway. So I will now shut up for about 10 minutes just to refresh my coffee, and I'll be back with you, and we will look at cash flow and the P&L in a second or two. 47. Yes, so I'll be back a whisker before 3 o'clock with a fresh coffee, and we'll look at those. Right, hello. So now we will look at cash flow and P&L, profit and loss. They are not the same thing. They are related. They are closely related. And in fact, for a business that doesn't do any offering of credit to anybody, they are pretty much the same, arranged differently. So a cash flow is all about money through the business. A P&L is all about sales. It shows the amount of profit or potential profit that a business is making. And it's the result of deducting allowable business expenditure from sales turnover. Allowable business expenditure. Now there's a thing. That's what we were talking about earlier on. You need to know what your allowable categories, if you like, are, what you can claim as a cost, because A, that will show what your profitability is like. B, it'll reduce your tax bill because you need to show those things for the tax man as well, tax person as well. So a P&L shows the amount of profit a venture is making, or in the case of a profit and loss forecast, which is very commonly used for startup businesses, it shows the amount of profit a business is forecast to make. And it's very simple. It's the result of deducting allowable business expenditure from sales turnover or from forecast turnover. It's like that. So sales turnover minus direct cost, which is cost of sales, which is variable cost. Those are three labels. They mean the same thing, equals gross profit. Cost of sales is that cost that you only incur when you sell stuff. So your sales turnover is all your sales, your invoicing added together. Your direct cost is the materials you use in what you sell. So if you're a cake maker, which is this example we'll get to in a second, if you're a cake maker, the direct cost is flour, sugar, butter, cupcake papers, cherries, icing, all your ingredients and your costs. Probably delivery costs, postage costs, things that you only incur if or when you sell. Now, having got to that, your gross profit, so total income, total turnover, minus direct cost of sales, equals gross profit. Minus your overheads, your indirect costs, equals net profit. And your overheads are the costs of running the business. So these ones, direct costs, they're the costs you only get when you sell stuff or when you make stuff to sell. These costs are costs that you've got anyway. They are going to happen whether you sell or you don't. For example, office rental, telephones, some aspects of your business travel, probably, insurance, electricity, gas. If you've got these things as part of your business, if you're working from home, there's a different thing. But if you're renting a unit somewhere, you're manufacturing things, it's those costs, the costs that you have to pay whether you sell or you don't. So that's how gross profit and net profit are derived. The allowable business expenditure side of things, we'll have a little bit of a look at that now, because moving on, there's phone numbers you can access HMRC's advice from. That is a bit of a list of them, just to say that a business can incur any expenditure things fit and proper. Those are the rules. The rules are your rules within the law. So within the law, if you decide that your business needs a new computer, that's fit and proper. Of course it is. Nothing wrong with having a new computer if the business has got the money to do it, and you, as owner of the business, decide to spend the business's money on a new computer. Of course you can. Whether it needs a new bedside table for your bedroom, I think not. That is not fit and proper. So the business spending money on things for you, no. The business spending money on things for it, yes, broadly speaking. And again, as I said at the very beginning, I say again, I am not an accountant. I am not a lawyer. I am not a financially qualified person. What's that? Financially, the regulatory body, FCA, Financial Conduct Authority. So we are not FCA controlled. So this is financial information. This is information about the tax system. It is not financial advice. So a business can incur any expenditure things fit and proper. Only that which is wholly and exclusively incurred for the purpose of the business is allowable for tax. And not even all of that. Because if you maintain that you are buying 2 pairs of jeans and 3 t-shirts entirely for the purpose of the business, because those clothes are what I work in. Unfortunately, clothes is a particular category that HMRC are very picky about. And if it's normal clothing, which jeans and t-shirts surely are, you can't claim it. And it's no good you saying, I work in jeans and t-shirts, I never wear them any other time. Doesn't matter. HMRC will not accept normal clothing, in quotes, as an allowable business cost. If you're not sure, seek professional advice. If you're really not sure and you're really bothered about it, contact HMRC. They will always give you a judgment. They will not give you advice. So it's no good ringing HMRC up and saying, what do you think I should do? Because they quite rightly will say, that's not what we're not here for that. We are here to account for your taxes and to make sure that you get all you're supposed to and we get all we're supposed to. They are absolutely straight, HMRC. And by the way, they are not stupid and they are not unreasonable. So if you have a problem with HMRC or you believe something's wrong, contact them. Because if they think you owe them money and you don't think you do, if you don't discuss it with them, they'll pursue you for the money because they'll assume that they've told you that they're chasing you and you haven't come back to them. So they'll chase you for the money. So if something happens that you think is wrong or you don't understand, contact them. They can take a very long time to answer the phone sometimes. I mean, a very long time. However, every time I've rung them, to ask them questions for clients or whatever, they've always been very, very helpful. They're dead straight, either in their favour or in your favour. Then, they don't take sides. They're dead straight. They'll tell you what the rules are, but they won't advise you. They'll give you a judgment on a case. So if you say, I do this, can I claim it, for example, they'll say yes or no. So, as I say, if you're not sure, seek professional advice. Sorry, this page is refusing to, there we go. Sorry, the page wouldn't click over there. These are the phone numbers for contact, income tax, self-assessment, or employers if you're employing people. Their contact numbers. There's a catch-all contact number for HMRC, and you'll finish up with, press 1 for this, 2 for that. But those are the HMRC contact numbers. Now, business expenditure. Things you can and can't claim as a cost. Broadly speaking, the rules for limited companies and sole traders are the same. There is a difference. I wonder if we've got it next slide. No, there, that one. So use of home for the self-employed is different to the use of home for employees of limited companies. I don't know why. I'll get to that in a second. But that's an example where there is a difference between self-employed and limited company. No idea why it's different, because if you're a person working from home in your own business, the costs are the same. But that's just one of the, there are occasional strangenesses in this massive, massive set of rules that is the HMRC process. So we've got things that are allowable, things that are not allowable. Not allowable are essentially, broadly, you can have everything that you spend on the business except food, clothing, and personal items. So food, clothing, and personal stuff. That's not allowable. Entertainment doesn't exist. Business entertainment, there is no such thing. And it's no good saying, I used to work for a big company, they let us entertain their clients. That's entirely up to them. They can reimburse your expenses. You could take a client to lunch and they could say, we will reimburse your expenses. They cannot claim that as a business expense. And if they are doing, HMRC will be very cross if they catch them. However, this entertaining clients thing is a bit of a variable process, because you cannot entertain, because entertainment implies a jolly, that you're an inducement. You're trying to get business by taking people to lunch, taking them overseas. That is not allowable. Meetings are allowable. So if you and I are building a housing estate together, and you're the builder and I'm the architect or whatever, and we have a meeting, and we have steak and chips while we're doing it, that food is probably okay because it's a meeting cost. Certainly, if you're running a training course and you provide sandwiches, that is an allowable cost. It's not allowable if you charge the people for the sandwiches. If you provide the sandwiches as part of the course, it is allowable. That's the trouble with things like this. You see, you get down to tiny details. The question, are sandwiches allowable? In what context? Have you provided them free as part of the course? Are you charging people for them? And if in doubt, check with HMRC. But broadly speaking, you can have, as a business expenditure, everything except food, drink, and clothes, with some exceptions. So the food and drink exception, the obvious one is meeting costs, I believe, are still okay. Entertainment absolutely is not, can't be done. There's a thing called subsistence, where you can claim £5 a meal. If the business makes you drive really early on, you can have breakfast. If you've got, for example, I'm in Watford, right? So if I've got a meeting in Manchester at 9 o'clock tomorrow morning, I'm going to have to leave home crazy early. Well, I don't know what time you think is crazy early, but to get to Manchester for 9, I reckon I'd have to leave home about 5. I think that's crazy early, possibly even earlier. So I think that's crazy early. So the business could buy me breakfast on the way up. That's reasonable. Either the business, I'd buy breakfast and take the money for the breakfast out of the business account, putting in a note that it was breakfast on the way and a receipt, or the business can give me a £5 allowance for subsistence because it's made me get up really early and drive to be at an early meeting. Same thing with coming back late. If you're really a long way out of hours, and reasonableness applies, 1 minute past 5, obviously not, midnight, obviously. Somewhere in between is a break point. So reasonableness applies. And I don't know what's reasonable for you, and I don't know what's normal. That's a judgment call for you to make. If in doubt, check with HMRC. However, the business can reimburse you for early starts, late finishes. Obviously, if you're away, if you go to this meeting I've made up in Manchester, and you have to stop overnight because there's a meeting in the afternoon and there's another one the following morning, then your hotel bill, your food, your breakfast, that's all an allowable cost because business has made you leave home to further its interests. So you can't have clothing either, except if it's safety or uniforms. So uniforms includes things like tabards, overalls, anything, but safety includes protective. So any PPE, personal protective equipment, masks, gowns, anything like masks or gowns or tabards, overalls in the beauty business, or barbers or hairdressers. Those things are allowable. Trying to think what else. Toe protector boots, headwear, head coverings, safety glasses, all these things are okay. A uniform is okay. It's no good you saying I wear jeans and t-shirt as my uniform. HMRC will say if they catch you, if they spot check you and they catch you doing that, they will make you take those figures out, probably redo your last tax return, maybe make an adjustment in the next one. I don't know if it's very small. I don't know what their rules are, but I do know that clothing that is not specifically uniform or safety is pretty much generally not allowed. Golf clubs, health clubs, gyms, all that, no. It's no good saying I do a lot of business on the golf course. That's nice. It's not an allowable cost. I suspect it is an allowable cost, membership of a golf club, if you're a golf pro. So there are horses for courses here. There are different things. So, for example, if you're an actor, there are a very different set of rules for actors. A self-employed actor can claim gym membership, can claim facials, barber, hairdresser, clothes, I believe, for auditions, because without looking right, you can't get the parts. So I believe actors, and I think you have to be registered with Equity and Spotlight, but I think actors have a special status. Generally speaking, the rest of us can't. Also not allowable personal drawings. So if you're self-employed, you can't claim as an allowable cost the money you take out of the business. Being self-employed means that when all the costs have come out, what's left is yours and you pay tax on it. So your money isn't a salary. You don't get a salary. You get, what do they call it? You get drawings. And that doesn't mean a selection of, here's mummy hanging out the washing. Drawings are what people who are self-employed call the money they take from the business. It's not wages, it's not salary, it's called drawings. So as you go along through the year, you can take money out of the business as long as you keep track of it. And come the year end, total income minus total costs, what's left is yours. And that's what you pay tax on. And then what's left is absolutely yours to do what you like with. So drawings are what I can't say it. Drawings are what self-employed people get out of their business. Special rules, pension. If you're taking pension from a business, or if you're making enough money to be putting money into a pension plan, lovely, please take advice. It's a very specialized area, not necessarily an accountant. I'm far from, I wouldn't dream of decrying accountants. They are hugely qualified professional people. However, if it's a pension thing, you probably need a pension specialist, which may well not be an accountant or your accountant if you choose to use one. So pensions, there are things you can do with pension schemes that are very tax efficient indeed. And if you're in a position to do that sort of thing, please take advice, because there's very definitely a right way and a wrong way of doing it. Capital items, writing down allowances. Yeah, I'll come to that later, probably in cash flow. There's a process where you, rather than having depreciation, now I'll try and explain it now. Depreciation, if you buy something big, is basically you defray the cost over a few years. Because if you buy something big, and I'm talking like you've got a factory and you buy a new laser cutter and it's cost £100,000. Well, that £100,000, you would, back in the day, you would have bought that laser cutter for £100,000. And if you thought that's going to be good for 5 years, then you reduce its cost, you depreciate it over 5 years. So let's take it a really simple way, straight line depreciation. We will assume that this £100,000 machine drops £20,000 every year. So in year one, it's cost me 100,000. Year two, it's worth 80. Year three, it's worth 60. Year four, it's worth 20. Year 40, 20, and then nothing. So after 5 years, this machine is worth nothing. That's the depreciation process. And that's where you get to a position where you own the machine, it's still working, but technically it's not worth anything. Because it could easily have broken down year five. Year five, 5 years is what you would expect it to last. So then if you sell it, you have to declare that income to the business as an income, but you chop its cost up over a period of time. The purchase of capital items, the writing, it's called general valuation. No, I forget. It's got a special name. And HMRC have brought in a process where if you buy big things like £100,000, you can put it through your books or on your tax return in the year in which you buy it. Yes, it will make you make a huge loss. You may have taken out a loan to buy it or whatever, in which case those costs go in. But you can include the whole of the £100,000 in the year in which you buy the machine, which means that you make probably a £80,000 loss in that year. Then you carry that loss forward to the next year as a cost. So the cost gradually works its way down over time. I won't bang on about that. Take advice. If you're buying large capital items, take advice, unless you're comfortable doing it. I mean, look it up on HMRC website. There's ways of doing it. But that is outside the remit of this webinar. This is about the basic process. So special rules, capital item, it's general valuation, GVA, general valuation allowance. Anyway, depreciation is a special thing. Pensions certainly are a special thing. And if you're admitting to using your laptop for private use, then if you say 40% of this laptop is private use, then you're only allowed to claim 60% of the value of it as a business cost. Things like that. So there's a lot of exclusions and rules for business expenditure, but broadly speaking, keep record of your travel. Generally speaking, the way to handle travel is that you do 45p a mile for every mile that you drive. Let's see if the next one's going to, here we go. So generally speaking, you go 45p a mile for every mile you drive, or you can go the actual cost method. There are two ways of doing cars, actual cost method and mileage method. was just thinking, has it got have they changed it? Has it got a posh name? But no, it's the mileage method. So 2 ways of doing it. The depreciation way, I'm not going to work my way right through this, but broadly speaking, what happens is you work out how much of the car's life is business, and you do that by keeping a mileage log. You've got to keep a mileage log, whatever you do, both ways, always. You must record your business mileage. So if your business mileage is carefully recorded, and half of the car's life is business, so it does 16,000 miles in the year. Oh, hang on, let's use this. So it does 20,500 miles in the year, 10,250 are business. So half of the car's life is business. Therefore, the car is worth £10,000. Half of its life is business. So its business cost is £5,000. You can claim depreciation on that. And you can claim the car tax, the servicing, the repairs, the MOT, all your petrol. Got to keep the receipts, all of that, or diesel. Keep all of these things, and half of them are a business cost, because half the car's life is business, because we know that from its mileage. Almost without exception, this is going to be A, a nuisance to do, and B, not as good as this. Almost always, unless you've got a very heavily depreciating car, so it needs to be new, this is not worth doing. This way, dead easy, 45p a mile every mile you drive, up to 10,000 miles, and then it's 25p a mile after that. So 10,000 miles, 45p a mile, 250 miles, 25p a mile. And you know you've done 10,250 miles because you've added up your diary. Not difficult. So this would be 4,562. Almost always, this is a better way of doing it. It's so much easier because all you do is record your money. You don't keep any receipts. You don't keep your petrol. You don't keep that 45p a mile covers everything. And it's not generous, but it's not unreasonable. And the process is so simple. You just keep track of your mileage. This way, you've got to keep every receipt. It's a real nuisance. Hey, I've got a question. Wow, God, Joanne, somebody was going to ask that, weren't they? Yeah, okay, I'll do my best. Thank you, Joanne. I'll be absolutely honest, I'd forgotten it, but always somebody asks about electric cars. Right, good question. So Joanne's asked, what about electric cars? Electric cars are a very special case, and hybrids. So with a car, particularly a full-blown electric, if the business warrants it and you've got the money, the business, I should have said at the beginning of this process, these are based on you own the car and you charge the business for its use. If the business owns the car, you finish up. I'm going to try and go backwards now. That's going to work. There we go. Expenses, including private use. That will bite you if it's a company car. They tax you. They tax you to death on it. It really is not a plan to have a company car. Except, and thank you, Joanne, except electric cars. At the moment, the company buys an electric car. It lets you drive it free and clear. The company takes the cost of the car in total, and you get free use of the electric car. At the moment, they may well phase that down over time, but at the moment, that's how it works. That's how it is. So electric cars, investigate if you're thinking of getting an electric car for the business. The main reason not to seems to be mileage. So if you do only small local mileages, it's a blindingly good idea. So yeah, check with HMRC, because on their website there will be the rules on electric cars, and they'll probably tell you what the rules are for next year as well. But generally speaking, electric cars, yes, very good idea. A lot of hybrid cars, also very good idea. So in those instances, it's worth the business buying the car and you driving it free of charge. That's the easy way, and it's very, very cost effective. Because they're obviously, the government are obviously incentivizing everybody if they can to go electric, because net zero 2050 or 2030, or when the dates move about a bit. But yeah, net zero is a good thing. We should all be aiming for it. So yeah, electric cars, investigate, but they are a good idea from the planet's point of view and your pocket's point of view as well. So my pleasure. I wasn't much help. It wasn't very precise, was it? But yeah, generally speaking, if you can do it, it's a great idea. If your distance travelled is relatively low, that's what makes me nervous about them. long distance travel, not being able to charge it. But I think they're a brilliant idea. I think if you can, you should. So business expenditure, that's cars. That's how you do them. No, it won't move on again. There we go. This one was the one that I gave as an example of differences between self-employed and limited company. If you're self-employed, working from home, 20 to these, right, there you go. You can read. I won't read them to you. Those are the rates, the time. So if you run a business from home and you're working more than 101 hours a month, you can claim £26 towards your heat, light, gas, rent, home costs, if you like. Now, somebody always asks, what about if I use, if I've got a dedicated office in the house? Well, I know several people who have in the past converted a room, excuse me, converted a room of their house to use exclusively as an office and have charged all the costs of doing that to the business. I don't know what HMRC's view on it would be. This was a few years ago, and they were advised to do it by their accountants. So take advice if you're going to do some major conversions. But if you've got your own business, my argument would be you are working more than 101 hours a month. And you see, it doesn't say, to my mind, it doesn't mean if you're running a business from home, this 101 hours doesn't mean the time you're physically doing what the business does. I don't know, making baskets, cooking cakes, rewiring radio player, whatever it is. It's managing and running a business, not physically working in the business. So if you're running a business, you are going to be thinking about the business most of the time you're awake. Now that comes down to, if it's 101 hours a month, that's 25 hours a week, slightly less actually. So if it's 25 hours a week, 7 days in a week, it's about 3 and a bit hours a day. You are going to be thinking about your business more than 3 hours a day, that's for sure. And you're going to be working on the business as well. So I honestly think that £26 a month is completely reasonable for everybody running a business from home, whether you're physically working on the business or not, because you'll be sitting watching television, thinking about it. You wake up in the night worrying about it, all of that. So that I think is reasonable, entirely up to you. £18 a month is I don't know why is it £8 a month less if you're an employee of a limited company than if you're self-employed. I really don't know. I do not know. But those are the current rates. So if you're a limited company, you can claim a flat rate, £18 a month. No receipts, no nothing. You just put it in your books. These are expenses you can claim from your business, and your business, whether it be a limited company or your self-employed bank account, if you like, whether you've got it, whether the business has its own bank account or whatever. So this is you taking money out of the business bank account into your pocket, tax-free, because it's an expense being reimbursed. And then the business, this £26 a month, let's say. So you take £26 a month out of the business bank account, or at the end of the year, you take £312. I did that on my head, I might be wrong. 26 times 12. You take £312 out of the business bank account, tax-free, into your pocket, and the business treats that £312 as an allowable business cost, which will reduce its tax bill. That's how it works. So those are the categories of business expenditure usage from home. Here's a P&L. So we've looked at the different allowable costs, if you like. This is a P&L. I apologize for all the numbers on the screen. That's how it is. So broken out by month, left to right. You'd probably have January, February, March, or whatever, July, August, September. Very simple. Each month going down, right? Income. We've got two forms of it. This is a cake company. Celebration Cakes, there's a clue in the name. This is a cake company. Celebration Cakes from a market stall, £335. To the trade, £300. So in this month, the first month of this trading year, we've done £635 worth of sales. So we categorize the sales. You could have one category, you could have 100, but it's entirely up to you. So we're selling cakes ourselves on our market stall, and we're selling cakes to the trade. Total sales this month, £635. Cost of sales, butter, flour, decorations, cupcake papers, all that, 70 quid. gross profit 565. So sales 635 minus cost of sales 70 equals gross profit, minus overhead, gas, electric, insurances, postage, stationery, travel, all these things. These are the things that happen. Notice they're pretty much the same month on month, and they wouldn't be, they would vary, but they're the same month on month, with an exception. Bing, catch you out. So these things occur whether you sell or you don't. Total expenses there. If you were doing your own spreadsheet, you could lay it out how you liked. You wouldn't have it in these colors. You would probably have bigger spaces between things. To fit them on the screen, we've done it this way. So gross profit equals that. Cost of running the business, overhead, equals this, which is £387. So that is your total expenses. So you take that from your gross profit, which equals your net profit. So 178, so yeah, there's miscellaneous income. That's always there. That's for other things. I don't know, you might be renting something to somebody. You might have another disparate stream of income that doesn't come into your sales. So that's there as a catch-all. So net profit, £178. So in month one, we've done £635 of the sales, and we've made a net profit of £178. Lovely. We need £500 a month to live on. That isn't sales, and it isn't the cost of running the business because we're self-employed in this example. So we've put that down the bottom. So we know that we need £500 a month. That is our survival budget. That is our rent and our living costs for the month, because we live with somebody else and part of our living costs are covered by them, but we need to contribute £500. So that's there. So in this month, we're a bit short, and the following month. Third month, we need £500. We've got £510 profit. So it's starting to pick up. Businesses are like this. It takes a while to get going. Of course it does. So, however, here's the thing. Profit and loss is nothing to do with money. It's all about sales, right? It's to do with money to the extent that it's measured in money. So all these figures are pounds, but that's it. It's about sales. This is the total sales. That's the sales cost. That's therefore our gross profit, all of that. None of this says there's any money come into the business. It's about sales and their costs. A cash flow is all about money through the business. A P&L is not. It's about sales and their cost, because the cakes to the trade, £300. You record in a profit and loss when the sale is made. We give the trade credit. The trade will not pay us that £300 until probably month 3, quite likely month 4. Some local councils, you can be months and months and months. Councils are always good for the money, but sometimes they take a very long time to pay. This isn't a Wenta comment. This is from talking to clients, by the way. So that's the shape of a P&L month on month, and it rolls over. And you'll note that the costs, like gas and electric, £20 a month, insurance, £20 a month, are spread through the year. Insurance, you wouldn't pay your insurance monthly, or you could. Most people tend to pay it in one hit if they can up front before trading. So it's in place, ready to go. But because the business bears the cost through the year, you split it up. So things like insurance and travel costs and gas and electricity costs are shown split up equally through the business, through the year. And that one is an oddball, because it should be spread evenly through the year, because that's fair. Because that way each each month carries its share of that cost. So on a profit and loss, it's about sales. It's measured in money, but it's not about money. It doesn't say the money's in the business. It says the sale has been made, and these are the costs of making that sale, the costs of running the business on a monthly basis. That's what it's telling us. So, having determined that, we look at a cash flow. So the profit and loss, sorry, I will go back. It looked okay. It's making a profit. There we go. There's a minimal loss here. And then from month 3, profit left over, our requirement is 500. It's going nicely. So at the end of the year, £10,351 profit, from which we would take 6,000 as our costs. There's £4,000 left over. So we've paid ourselves enough to live on. cleared 4 grand and going into year 2, relatively cheerful. That's fine. Now, a cash flow is a very different thing. A cash flow is made of real money, real time coming through the business. There are pre-start costs, then there's an opening bank balance, money comes in, money goes out, and then whatever's left gets carried forward to the next month. It's about money, not sales, just money. And to start it off, you need to know what these things are. You need to know your startup costs, your insurance, premises costs, stock, marketing. So in the early stages of a cash flow, if you're starting a business or planning a business, somebody, possibly one of us, is going to say to you, how much are you going to spend to start the business? And you're going to say, I've got no idea. And these are some of the things you need to think about. And that there aren't absolute answers. Some there are. Insurance, you're going to be able to get quotes and go, it's going to cost me £207.50. You'll know. Premises, you'll have a good idea if you're taking premises. Stock, how much stock are you going to buy? There might be ingredients, it might be materials, it might be steel. I don't know what it is. How much are you going to have to spend on stock to get started? Are you going to do any marketing before you start? Travel costs, licenses, permissions, accreditations, memberships of societies, memberships of trade bodies, and you may need working capital. So if you need £1,000 a month, no, let's stick with the example. You need £500 a month to live on. And if you know in the first 2 or 3 months you are not going to be getting that much coming in, you need enough working capital to keep you alive while the business gets going. So working capital is just the money you need to keep you going whilst it all gets, the business gets underway. So what is startup costs? These. Right. Bear in mind, the cakes we've sold, so this is the cash flow that goes with that profit and loss we just looked at. Bear in mind that the cakes sold to the trade are paid 60 days. We give 60 days credit. There's no rules on credit, by the way. There are no rules. You don't have to give anybody credit. You don't have to give them any credit at all. You can say, there's the goods, I want the money. Because that's how most markets work. You turn up at a market and say, I'll have some tomatoes, please. I'll pay you next week. It won't give you the tomatoes. So most cash businesses are just that, cash. Here's the goods, here's the cash, thank you. If you're dealing with the trade, so you're acting as a wholesaler, effectively, they will probably want credit. 30 days, 60 days, 10 days, whatever. In this instance, we're assuming that cakes sold to the trade will pay them on 60-day invoices. I'm now going to skate back 3. That means that this money here, cakes sold to the trade, are not going to be seen. We're not going to see that money until here. That means that that month we're £300 short. That month we're £300 short. So we're £600 down by the end of month 2 because these people haven't paid us. In reality, I think we should make the money coming in month 4 because they won't pay us in month 3 either. If that's just how life is. So we'll assume that gas and electricity are paid quarterly. This is going back in the day when it was paid quarterly as an example for the cash flow, because the profit and loss showed it spread evenly through the year. The cash flow shows when the actual payments go out. So gas, electric, telephone, we're assuming are paid quarterly, and your insurance is paid before you start trading. So this is your cash flow. Now, excuse me. The cash flow, just like the profit and loss, is broken out into months. But there's a one on the front end, pre-start, because you can't have a pre-start column on your profit and loss because the profit and loss is based around sales, and you can't make any sales before you start trading because by definition, when you're making sales, you're trading. So profit and loss has the first column, the first month's trading. Cash flow has the first column as being your pre-start costs. Now, pre-start income, nothing, because you can't sell anything before you start trading because that means you're trading. The owner has put £1,000 in to start the business. Pre-start income, £1,000. So total income, £1,000. Total income in January, nothing from the trade. They're the other way around, by the way, here, sorry. Nothing from the trade, 335 from the market store. I'm going to go backwards. That, 335 from the market store. Month 2, 335, month 3, 600. Month 2, 335. Month 3, 600. Sales from the market stall. So month 1, nothing from the trade. Month 2, nothing from the trade. Of course, they're not paying us. We haven't asked them to. We've said we've given 60 days. Month 3, £300 from the trade. That's the sales we made in January. If we made those sales on the 30th of January, I don't think we'd get that money until here. I think that ought to be a 0 as well, if you're being cautious. We've put it there because, strictly speaking, 60 days, you'd take the middle of the month as a forecast or something like that. It's whatever works for you. There's no hard and fast rules. But to be conservative about it, I would leave that until the following month, simply because the likelihood of getting paid 60 days after the 30th of January, or the last day of January, last day of February is the last day of March. They are not going to pay you on the last day of March. They're going to leave it on another month. Cakes from the market stall, no problem. Cash sales, they come in as always. Capital introduced, £1,000 from the owner. So total income month by month is that. So there's no mention of cost of sales. This is just about income. Cash flow is broken down into income and expenditure. So money coming in, £1,000. We've stuck £1,000 in to start the business. Money going out, ingredients, cake equipment, bowls, a mixer, all the rest of it. That didn't show in the profit and loss, remember. Insurance, £240 up front, postage, stationery, food hygiene, qualifications, travel, transport. So we've spent £1,590, 500 quid on a computer, 1590 going out. £1,000 coming in, 1590 going out. Now, that means, obviously, that you're £590 short, okay? So we roll on in that knowledge. January, our cash flow forecast shows us, because this is a paper exercise, you're not trading yet, this is a paper exercise. January, 335 comes in because the trade haven't paid. The costs are material costs and everything else we have to pay as we go along. 854 costs, 335 coming in. So we're 519 down. Month 2, 335 coming in, 794 going out. Now I think month 3 should be 0 coming in as well, but it's not. 900 coming in, 890 going out. Whoa, hang on, we've turned the corner. We've now got a slight surplus. Going back to month 1 then, pre-start income £1,000, pre-start cost 1590, so we're minus 590. No money in the bank to start with, 590 negative is the closing balance. Closing balance, opening balance. So the closing balance in this month becomes the opening balance in the next month. 335 coming in, 854 going out, minus 519. We started at minus 590, so we're closing the month at minus 1109, which goes in there, becomes the opening balance there. 335 in, 794 out. We are now minus 1568. This is as bad as it gets because we know that the following month we start to get into profit. However, the fact that we've got into profit, we're minus 1568, minus 1558, minus 1, minus. So it takes us 6 months to get out of negativity. But here's the thing, there's no such thing as minus money. There is no such thing. It's a construct. It cannot exist. There is no such thing as minus 148 quid. It's a mathematical idea. So for you, if this is your business, that bottom line means you can't start the business. Unless in the bottom line of a cash flow, if there are negative figures, you have to have something that says, I have agreed a £2,000 overdraft with the bank. I have agreed that I can borrow £2,000 if I need to from somebody or other. I have agreed with my suppliers that they won't charge me for, you need a reason to make this negative figure go away, because minus figures on the bottom line of a cash flow mean the cash flow doesn't work. Because in this case, you'd get to month 2, you're minus £1,500. If you haven't agreed an overdraft, the bank are going to ring you up and stop your trading. Say, stop. We are not honouring any more of your checks. Tell your suppliers we won't be paying them. Where's this money coming from? To make this problem go away, you have to put £1,568 more in. That's why doing a cash flow is so useful, because if you don't do this cash flow, you'd look at the business and you'd think, let's go back a few again. You look at it and you think, well, I reckon I'm going to be doing 500, 600, 900, 1,000 a month. and the business costs me approximately £400 or £500 a month to run, which it does, I'll be fine. However, yes, you will be fine, but the shape of the business, the shape of the money through the business means, because of you giving credit to people and because you have to pay up front for some things, that you need £1,568 more than you've got for this business to work. So with a cash flow, the important thing with the cash flow is it isn't telling you, and a P&L to some extent as well, it isn't telling you how the business is going to work. It's telling you if the business is going to work. And this business isn't going to work. There's nothing wrong with it as a business, not a thing. But doing the cash flow shows that unless you put some injection in, you can't trade. A couple of solutions: maybe give less credit. That'll bring £300 further forward to here. Maybe try and negotiate credit with your suppliers, but that's small. That's a very small amount. There isn't a great deal you can do. So you've got to put money in or borrow money. And that's what the cash flow shows you in this example. It takes 6 months to get back to being positive. And that's not unusual. It's not a bad thing. It's just a thing. And you need to know what it's like for your business so you know how the business is going to look. You may well find, if you do one of these, that you're actually still conservative because you're doing it with a positive mindset, which is a good thing. You need a positive mindset to start a business. But if I was doing one for real, I would take that £300, I would shunt this whole row to the right by a whole month, which would make the situation £300 worse. I'd say you need £2,000 more to start the business, at least. And then then you're good to go. Because come the year end, you're taking your money out every month. It's working. There's positive money in. Through you've got nearly £4,000 left in the bank at the end of the year. You've paid yourself. It's working. But for it to work, it needs a little bit more money in there in the first place. And that's what a cash flow's for. So different ways of raising finance, ways to get finance. The left-hand one here, the 3 Fs, is a sort of bit of a joke: friends, fools, and family. Those are possible ways of getting money. Friends, fools, and family. Banks and other debt financiers. Banks at the moment, I don't know for certain, but I hear that banks will lend about 50-50 on a strong business plan. So if, for example, you needed to borrow £2,000 to start that last business, to borrow £2,000, they'd probably want to see you putting at least £2,000 in yourself. And the shape of that business was probably okay. So, you could probably evidence that you'd put in your computer, your phone, catering equipment you already owned. You could probably scrape together £2,000 you'd invested in the business. And you go to the bank and say, I've put £2,000 in. Can I borrow £2,000, please? Here's my business plan. And they might lend you the money. I don't know what it would cost because banks don't tell you what their commercial rates are until you apply for a loan. Another way of doing it, and probably the best game in town at the moment, is the government startup loan. And the government startup loan, which is on www.startuploans.co.uk, I think, bear with me, I'm going to skip forward. No, not there. I was looking for startuploans.co.uk. Might be on the last slide. It's in here somewhere. So startuploans.co.uk is the government scheme. Beware of anything that says it can find you grants for your business and asks you for a fee. I heard about 3 weeks ago from somebody who'd been asked for, I think it was 189 or 159, something like that. It was ending in a 9. And it looked like the website looked like it was the real thing. It looked like it was government, and it's not. It's a Canadian-based company. They were around some years ago. They appear to have come back. Anybody who asks you for money to tell you about grants is probably a scam. Treat them with great caution, because they'll say there are grants for small businesses, and you pay them the £169, and they come back to you and they say you can get a £500 grant if you're starting a business from home, helping children with special needs as a preschool nursery. So they've done what they said. They've told you there is a grant for a small business. It doesn't help you because you're trying to start a cake shop. Anyway, be very careful. If they're charging you, they may well be a scam. But treat it with caution. They're not all scammers, but be very, very cautious. High net worth individuals may invest grants, possibly, but they're incredibly rare at the moment. I don't know of anybody, there is one in Luton, a £500 startup grant in Luton, I believe is still there. Other than that, across Herts, Beds and Bucks, I don't know of any. High net worth individuals, angels, venture capitalists, they generally speaking want a large portion of your business. And generally speaking, for most startup businesses, you're not going to be big enough to interest them. Think Dragon's Den, that sort of thing. And that's massively unusual. Mostly people use the government startup loan, possibly a bank. Crowdfunding, we've had a few crowdfunding applications go through. We know a few successful crowdfunders, but they are quite rare as well. So those are different ways to get finance. And last section in this one, invoices. And then we'll go to, yay, VAT. So invoices. An invoice, very simple. An invoice is a piece of paper that tells somebody what you've done for them and how much they owe you and how they should pay you. So this is a screen grab of an online invoice. There's lots of invoices online. Templates available. Make one up yourself. Make one up yourself in Excel so that when you put the numbers in, it adds it up for you, I suggest. If you're a sole trader, the individual name should appear somewhere. So if you're Made Up Plumbing, down the bottom, this has got company number and all the rest of it because it's a company. If Made Up Plumbing was a sole trader, then Made Up Plumbing's owner should have their name and address. Made Up Plumbing, Sylvia Jackson, 25 Acacia Avenue, Hartlepool, down the bottom. Because if this invoice gets ignored and they don't pay you, Made Up Plumbing doesn't exist. It's just a trading name you're using as a sole trader. Sole trader names don't have any existence in law, generally speaking, unless you've trademarked it. And even then, I don't think it lets you sue. But Made Up Plumbing doesn't exist. Made Up Plumbing can't sue if whoever has been invoiced doesn't pay. The name of the business owner down the bottom means that this business owner can sue if these people don't pay. That's why you're on there. So you should show the legal identity of the business. So if it's a sole trader, your name goes on there. If it's a limited company, as you'll see down here, the registered office is down there, the company number's down there, the VAT number's down there. If it's registered for VAT, more on VAT after I've had another cup of coffee. So it's Made Up Plumbing. This is who the invoice is going to. This is what the invoice is for, goods or services. Invoice number, date, payment due date. That's not essential, but it's a good thing to put on there. Label it clearly invoice, contact details, your address, your phone number, your details. Bank details so they can make a payment straight through. Invoice total and terms of payment, either somewhere like, where's it gone there? It's there. Or quite often people will have terms of payment along with the bank details. Payment is due within 7 days of the date of this invoice or whatever. Now, that might be something you've agreed. That might just be something you put on the invoice in the hope of getting paid within 7 days. Good luck. Yeah. So that's broadly speaking an invoice. If you create one in Excel, save it as a PDF. Don't send Excel spreadsheets to clients because they can change them, they can lose them, they can modify them. They could inadvertently delete the figures. They could inadvertently, and I mean it, I'm not saying inadvertently in quotes, they could change the figures because a spreadsheet is an active thing. They could change the figures and you could find a payment being made for the wrong amount. Then you've got to go back to them and ask for them. So send a PDF. A PDF can't be changed. Well, not easily. So don't forget the incorporation number and the VAT registration number. And yeah, things like if you have any detailed questions, contact me, and late payment will incur charges as stated, etc. If these things are relevant. But basically, the addresses, the dates, what you've done, how soon you want paying, and the bank details so they can make the payment. That's sort of the groundswell of opinion on it. And we'll look at VAT and national insurance and tax layers of charging in a moment. So I'm going to switch this down to there and switch my mic off and go and make a coffee. I will be back at, what is it now? 5 past. I'm back at 4:05. VAT, national insurance contributions and tax. So VAT registration is compulsory if your turnover gets to 85,000. It's a rolling 12 months. So if in the next 30 days you think you're going to reach that total, based on this month plus the 11 before it, that's when you must register. So if you think you're going to register, if you think you're going to hit that total in the near future, you must register with HMRC. It's compulsory. Very straightforward. You go online through the government gateway, register for VAT as a sole trader, as a limited company. There's no restriction. You can register whatever your trading entity type, partnership. The main thing is the turnover. 85 grand, you must register. If you're turning over less than 85 grand, you can register. That's up to you, but you must if you get to 85,000. Now, the penalties for late registration are variable. They get worse the longer it goes on. If you've got questions about VAT, please ring HMRC. There's the number. Google it. They're on Google, obviously. Contact them if you have questions. But registering for VAT is very straightforward, but it's a must if you get to that level of turnover. And if you register for VAT, it means you must charge 20% VAT on everything you sell. That's what you must do. So special arrangements. If you're VAT registered, generally speaking, you'll do your returns quarterly, monthly, or annually. Quarterly used to be pretty much the standard default. I suspect it still is. Most people tend to do their VAT returns once a quarter. And the deadline is, if you're doing it for the quarter, January, February, March, then your VAT return will be due 7 days into the month after the last month of your VAT return. So if you're doing January, February, March, then you've got April. 7 days into May is the deadline. So you get a month and a week. And that's how it works. Generally speaking, if you're small, you can use the cash accounting basis. So you do your VAT return based on how much money's come in and how much money's gone out. Nice and straightforward. So basically, you give the government 20% of what you sell. So you add it. It's not supposed to penalise you. So if you're selling £100 of the goods, you go VAT registered, you're still selling £100 of the goods, but your customer is paying £120 because they pay the VAT. Your customers pay the VAT. And then you send that VAT to the government at the end of the quarter. So at the end of the quarter, you take the VAT that you've charged people and you send it to the government. But before you do that, you deduct from it the VAT that you've paid on things you've bought for the business. Now, generally speaking, you're going to be buying more for the business than you're selling. Sorry, you're going to be buying less for the business than you're selling, because otherwise it's not sustainable. Some months you may, depending on your invoicing pattern, you may find that you've bought lots of stock and you haven't actually sold anything. And if that happens in a quarter, then HMRC will owe you money and they send it back to you. So if you've bought £1,000 of stock plus that, so you've spent £1,200 and you've sold nothing, they send you the £200 back. That's not very usual for more than one possibly two VAT period at a time. Now, when you register, the first time you register on your first VAT return, you can claim for the VAT you've spent on equipment and stock that you've already got, everything you bought in the last 4 years. So if you bought a load of leaflets that you've still got, a tent you've still got, some showroom equipment you've still got, machinery that you've still got, emphasize that you've still got. If it's not in the business anymore, it doesn't count. But as long as you've got the receipt, the VAT receipt for the equipment, you can claim the VAT. So it's not unusual for people's first VAT return to, because it can include all this like legacy money, if you like. It's not unusual for the government to owe you money on your first VAT return. It happens quite a lot. And I did ring the VAT people a long time ago for a client who was doing this. And I said, he's very worried because you're going to owe him money. And the helpline said, yeah, that's quite common because you've done spending over the 4 years, and you sort of claim it back in one go. So you can claim back the VAT on things you bought prior to you registering for VAT. There are special arrangements for things like importing, exporting. Some things have special rates on them, 0 rates, exempt suppliers. Contact HMRC. This is a specialist area. Contact HMRC. If, for example, you're selling educational materials, I believe they're 0 rated. They may be exempt. The effect is the same. They don't have VAT on them. But a 0 rating isn't the same as exemption, because 0 rating means they could be not 0 next year. So, depending on what you sell, if you're just selling standard products, look it up on Google. But if you're selling standard products, it's easy. If anything you're doing is specialized, check with HMRC. Now, there are circumstances where you might want to register for VAT before you have to, if you're turning over less than 85,000. Obvious example of that would be if you're selling, for example, children's clothes. I'm pretty sure children's clothes are not VAT-able. Therefore, when you sell them, you don't charge VAT. But you can get the VAT back on everything you buy. And it might be the rent on your little unit. It might be stock, telephone bill, transport, hotel bills. I don't know. But there might be a situation where it's worth registering for VAT anyway. And it's also worth registering for VAT if in the world you work in, everybody is registered for VAT, because then you'll fit into the same mold as everybody else. They won't care that you're charging them VAT because they'll just offset it against their sales VAT. So if everybody in your world is VAT registered, you may as well be as well. So VAT has some special arrangements. Income tax doesn't. It's very straightforward. Up to £12,570, you don't pay income tax. Between 12.5 and 50, you pay 20%. Over 50, you pay 40%, and then there's another tax band at the top. These tax bands change in the budgets. They change as any given political party is desperately trying to maintain its position as the party in power. Budgets are used as tools as marketing tools almost by governments of whatever shade. So be aware that whenever there is a budget, keep an eye out because these things may change. But for you, if you're a sole trader, you're earning up to £12,570, you're not going to pay any tax. You may pay national insurance, but these are the tax breaks, current tax breaks, 22, 23. Oh, not current anymore. We're past April the 5th. Sorry. Anyway, whoops, sorry. So the national insurance rates that go with those, if you're an employee, it's very different to if you're self-employed. Self-employed pay class 2 and class 4. Class 2 is £3.15 per week. As long as you've earned more than £6,725, you must pay £3.15 per week. Class 4 is earnings based and it's 9%. So 9% of your total income goes to HMRC and £3.15 per week. So you're going to lose about 10% in national insurance and, just go backwards one, 20% in tax for everything you earn over about 12,500. If you're an employee of your own limited company and paying yourself a salary, then the first £12,570, no tax, no national insurance either. Between 12.5 and 50, it's 12%. So what company directors and single director companies tend to do is they tend to pay themselves a little over 12,500, say 12,800 or something. That might be a plan, and it's a totally personal judgment thing, but that might be a plan because then, yes, you will pay national insurance, but not much, because you only pay national insurance on the bit that's over 12,570. And it keeps your national insurance record up to date for when you need a pension. Because if you haven't got 35 years of national insurance contributions, you don't get a full pension. So depending on your situation, it's quite common for people to pay themselves a salary of just over 12,570 so that their pension contributions are going in. For self-employed people, you don't have quite the same issue, because this £3.15p a week there, that is your pension contributions as a self-employed person. So that probably will sort things out for you. That'll give you 35 years of contributions, which gives you a full pension. So that's how national insurance rates work. And then tax for the self-employed. Remember all those timeline dates way back at the beginning of this webinar. For self-employed people, you will pay income tax, same as everybody else does, but you also get these. Do you remember I mentioned the payments on account? Do we have a timeline? No, we don't. Payments on account are, you pay your tax for the year plus a payment on account of 50% of that amount. So depending on how much it is, you're going to pay significantly more than you're expecting to if you're unaware of it. So please don't be unaware of it. Please be aware that you're going to be paying tax plus 50% in your first tax return, and then the following July, the other 50%, if you like. You're not paying in advance, you're paying catch up, and there's a balancing effect the following January when you do your next tax return. If you get confused by this, if you want to go through it with one of us, make a call, give us a shout. One of us will go through it with you by Zoom or by phone. It isn't difficult, but it is weird. It's weird. If this makes no sense, if you think I don't understand that at all, that's completely reasonable. Give us a call. One of us will go through it with you. I think it takes 2 or 3 goes to get the hang of it. And for those of you who've got it straight away, well done. But honestly, I think it's a strange thing, because you're not paying in advance, but it feels as if you are. So if you want one of us to go through it with you, that's cool. Give us a shout and we will. So this long delay on the first payment, it can be a very long time before your first tax payment goes out of your account, really. Yeah, it can be a very long time indeed. So put money aside to pay tax as you go along, in the knowledge that everything you earn over 12,500, you are going to lose 20% tax, 10% national insurance if you're self-employed. If you're an employee, you're doing the payroll, so you're in control of the payroll. You'll see it every month, you work it out. But for self-employed people, very commonly you get to the year end and think, damn, I've got a tax bill to pay and I didn't put any money aside. So please, every month, put money away. The easiest way of doing it is to think, I can earn £12,000 in very round terms. I can earn £12,000 a year before I pay tax. That's £1,000 a month. So I can earn £1,000 a month. So for each month, I look at the end of the month, what's come in and what's gone out. This is if you want to put money aside for tax, and it's up to you. Very sensible to do so. So at the end of the month, what's come in, let's say £3,000. What's gone out, let's say £800. That leaves 2,200. So I've made £2,200 profit this month. I know I can have £1,000 tax-free. That leaves £1,200. So what I should do is I should stick 30% of that away, because that's the tax bill and national insurance bill I'm going to face on this much money when my tax self-assessment's done. So in that example, I would stick £360 somewhere quiet, and the rest's mine. And I've put the money I need away for tax when I do my tax return. And that's a good way of doing it. Just work out very broadly how much you need and put the money away, because then when tax time comes around, depends on how safely you've done your figures, but when tax time comes around, you should have enough money to pay your tax bill. You may not have enough money to pay your tax bill with this extra 50%, unless you do stash the money every month. If you stash the money every month, you will not have a problem at all. So that is tax for the self-employed. For a limited company, it's rather different. A limited company, you see, has you on its payroll, possibly. Don't have to have, but very commonly, somebody owning a limited company and trading through it will pay themselves a salary, because then you're making the most of your tax, pretty much. So if you haven't got any other source of income, paying yourself something in salary makes a sensible idea. And that salary is part of the costs, part of the allowable costs. The costs of employment are part of the allowable costs of the company, the running costs of the company. So those come out. I'll work through an example in a second. Those come out, and whatever profit is left when all the costs have been removed from a limited company, the profit is then taxed. Just as for a sole trader, what's left is taxed at income tax levels, for a limited company, what's left is taxed at corporation tax, which at the moment is 19%. It's been the same as income tax for a long time. It's been 19% for a couple of years. So 19% corporation tax. So for a limited company, total money in, total money out, what's left gets taxed and then can be released to you. Hello, excuse me, I'll switch my phone off. It appears to be ringing. Yeah, so if you pay yourself dividend, that comes out of the profit after you've paid your corporation tax. So this is the rates of corporation tax, 8.75% basic rate. The first £2,000 of dividend is tax-free. The first £2,000 of dividend is tax-free. High rate taxpayers will pay 33.75%, and then if you're up in the, you're going to have somebody looking after your figures for you by the time you get to this. You will have an accountant doing things for you. The additional rate is nearly 40%. So there is a dividend allowance of £2,000. That may change with the next budget, because it tends to, but at the moment it's in place. And so this is how it would work if you've got a limited company and it's all working through. Let's say the turnover of the company is 60,000 and the allowable costs are 11,000. That leaves you with 49. So allowable business expenses, running costs of the business, cost of materials, all of that. That is £11,000 leaves you 49. The owner's salary of 12,500 also is an allowable cost. So that comes out, leaving you £36,430. Bear in mind that £36,430 is taxable, because that's what's left in the business. That's the profit that's left in the business. You've already had £12,500 out of the business. Lovely. That's 1,000 and about 50 a month. Anyway, it's just over 1,000 a month. So that's left in the business, 36,430. Corporation tax is then levied on that. So turnover minus allowable business expenses equals that, minus owner's salary equals that. So you've had 12,500 now. You're going to pay tax at 19%. Oops, sorry. You're going to pay tax at 19% on that. That's your tax bill. So you personally pay no tax. The company pays tax at 19%. That's the tax bill, 6,922. 6,922 is, at the moment, the total amount you're going to be paying. Oh, there's something buzzing somewhere. So 6,922 is the total amount you're going to be paying at the minute. Leaves net profit after tax 2,9508, £29,500. So the company has paid its tax bill, it's paid you, and there's nearly £30,000 left in the bank. So net profit after tax, £30,000-ish. That can be distributed as a dividend to the shareholders, which is you. So given that that's you, the first £2,000 is tax-free, leaves 27,000, and then that gets taxed at 8.75%. So you're going to get about, we haven't got the final figure there, so you'll pay tax at 8.75% on that, and then the rest is yours, which is approximately 3,000. You'll finish up with about 24,000 out of that, plus the 12,570 you've already got. Now, if you get to the point of thinking, is it worth me forming a limited company for the money? Am I going to be better off? Work it out. You can work it out. You can work out, it's very easy to work out how much you'll finish up with if you're a sole trader with a company with 60 grand turnover and 11 grand costs. Of that 49,000, owner's salary 12,570, that's tax-free, 36,430. You're going to pay 20% income tax plus 9% national insurance plus £3.15p a week national insurance on that, which is about 30%. 3,96380. That's about £11,000. So your total tax bill is going to be about £11,000 ish for a sole trader, and you can work it through depending on how much you want to pay yourself as a limited company. It's going to be close. It's probably going to be worth you being just about worth being a limited company for the money. But again, if you want to work it through with one of us, with what you think your costs might be and what you think your turnover might be, we'll do our best to go through it with you. We'll work out what your projected tax bill might be. So, yes, so that's we've reached the end of that. Then that's 2.5, not 3 hours. That one. I should have taken all the breaks. So we've covered sole traders, partnerships, limited companies, the basics of practical bookkeeping, a P&L and cash flow, and the ins and outs of invoicing and VAT. Be aware that these things change with budgets, and by all means, give one of us a shout. Summarising that, I think, on the next slide. Yeah, there we go. So that's the number to call. I'm sure you know it's all over our website as well. Contact us on that number. Any one of us will go through any of this with you. More than happy. Zoom, phone, depending on where you are, in person if you're anywhere near Stevenage, Watford or Enfield. But give us a shout. We'll go through it with you. Because particularly the way that sole trader, this might be just me, but particularly where the sole trader end of year works, it takes a couple of goes to get it sorted out in your head, I think. So if you want to go through it, no worries at all, give us a shout. So I will wind gracefully down to a close, and I'll just say to Joanne and Kitty and Nicola and Sylviane, thank you very much for being here. Hope it was a little bit useful. Thanks, Joanne, and thank you for the input on the electric card. I would have forgotten. Yeah, so thank you for being here. I'll leave this on for a minute in case anybody wants to put anything else up. Thank you, Sylviane. My pleasure. Thank you, Kitty. So all of you, good luck. All of you do come back. Thanks, Nicola. Just come back. Give us a shout if you want to just talk things through. It's, you don't have to have an agenda. If you give us a shout, just want to talk through what you're doing with your business startup, just bounce it past a stranger. That happens an awful lot, just to clarify your thinking. So give us a bell on that number. One of us, whoever's on the end of that, which will be Karen or Leandro at the moment, they will put you in our diary, and we'll go through it with you. So anything we can do to help, give us a shout. By all means, use all the rest of the webinars as well. And and good luck with it all. So I'll pause proceedings there, and thank you for listening.
And it's not like it's not done like a format option. So it's very quickly happening.